Guys, 2024 could very well be a volatile year, not just for markets, but for the U.S. economy. A year from now, we may look back and be a little surprised at what's happened in that past year.
So in this video, we are going to break down what has happened since 2020 and take a look at what could happen this year.
So after COVID, we had this COVID crash. We had the market crash, the economy shut down nothing. I believe the GDP contracted 34% in that one quarter.
That's all?
So then what did the U.S. government do? Started issuing checks.
Started giving away a ton of money.
Yeah, so people were able to pay their bills, but then it caused a problem because then what you had was you had a shortage of workers because they sat there and said, hey, listen, I'm going to get $600 a week no matter what happens here.
Yeah.
So caused inflation. Why? Because now workers needed more money in order to go to work.
Right.
Then we had a shortage of supplies. Remember how you couldn't get a car
Couldn't get anything.
Couldn't get anything.
I mean, think about how many things were supply chain issue.
Absolutely. Yeah. Absolute supply chain issues. So then what's happened since then? Well, things have, tapered down a little bit.
Stabilized.
You look at cars now, you can get more, there are more cars now. I remember, so on my way home, there's a big Chevy dealership, literally off the exit. Huge. And I remember when we were, even 2 years ago, I used to take that exit to go, I'd look at there and go, the lot was empty. And now it's full again. Yeah. And it's Tahoe, Suburbans, all these things. It's like, it's not cheap cars.
Right.
You know what I mean?
You went one polar opposite to the other polar opposite. It was, and like that too.
So now the economy is booming. They announced 5.1% GDP growth in the third quarter, but just this morning, they revised that back down to 4.9. I think it started at 4.9, went up to 5.1, back to 4.9. So the yield curve inverted, right?
Yeah.
For those of you who aren't familiar with what that means, usually when you borrow money from somebody, the longer you want the money, the higher the rate to pay, because it's more likely that something bad happens during that time, and they're tying up their money for a long period of time, opportunity costs, etc. So if you want to give money to the government, they're going to pay you a higher rate for 10 years versus 3 months. Well, right now, that is completely inverted. And that usually, the last 8 times that's happened, it's been right before a recession. Why? Because what people are saying is, we think the short term is riskier than the long term. Okay? So right now, what's the 10-year treasury at?
10 years at 3.84 right now.
And the 3 month?
The 3 month is at 5.36, 2 year, 4.31.
Guys, we're talking about
a large discrepancy.
We're talking about a 0.5% difference between the 10-year and 2-year, and a 1.5% difference between the 10-year and the 90-day treasury.
Yeah.
That's a huge difference. That is astronomically different. Imagine that. Imagine a world in which you live, in which you sit there and say to the government, hey, I'm going to let you borrow money, but the shorter you borrow the money for, the more I want paid, because I'm worried about your ability to pay bills in the next few months. Now, is that very likely to happen? I don't think so. But eventually, down the road, decades and decades, if this continues, that might be the case. The big news that came out this morning, manufacturing index again, contraction. Came out worse than expected.
Oh boy.
Now, remember, manufacturing over time has decreased in this country. Why? Because we've become so wealthy that it's hard to pay a factory worker $100,000 a year or $70,000 a year and still be able to sell goods in this country at a profit. So a lot of it's been outsourced. The percentage of U.S. jobs that are manufacturing keeps decreasing. But still, you look at manufacturing and say, if people are manufacturing less now here, it means people are demanding less. 17 of the last 19 months have been contraction.
Yeah. And then you couple that with what you saw from FedEx yesterday, how they're worried about shipping into the future. I'm sure that's going to linger into other shipping companies.
Well, somebody said, well, it has to do with Amazon. I'm like, no, they factor that in there when when they already give their expectations, they missed on revenue, they missed on profit. They knew the Amazon thing didn't just happen in one day. It had been building. And over time, FedEx goes, hey, we're getting less and less from Amazon. And now Amazon does everything on its own, basically.
Yeah.
So they've already factored that in there.
Right, exactly.
They already factored that in for next year. They already knew that was going to be an issue next year. I wonder how much, does Amazon assume still uses some FedEx and some UPS?
So. I would assume so.
But
especially
it's not
for big things.
Yeah.
Like FedEx Freight or something.
Or maybe in smaller towns where they can't have their own distribution center.
Right.
Yeah.
So these things are factored in.
I think so.
And when you start coupling manufacturing and then you say shipping, and it's just like this little spiral down of things that are in trouble.
Yeah, I mean, look at this article here. The Philadelphia Fed said Thursday its gauge of regional business activity fell to a negative 10.5 from a negative 5.9 in the previous month.
That's a big drop.
That is a big drop. Anything negative is contraction. Now, again, we're not trying to be fudsters here, guys. But what we are trying to do is be a little realistic, saying, hey, the The stock market is factoring in a booming economy. It's amazing to me that people are excited to see bad news in the economy because they feel like it means lower rates in the future. Yeah, but what does lower rates in the future mean? We've said this in many videos. It means the economy isn't doing well. And we're excited about that? You're telling me that an economy not doing well would be good for the stock market? No, it would not be good for the stock market. Absolutely not.
Yeah.
I'm sorry. That means companies would be making less money. More people would be laid off. Less people would be able to buy stuff. It's a circular pattern. Now, is it going to be like COVID or Great Recession? No, probably not. And is it going to be a soft landing? I don't know. I don't think I've ever remember a soft landing actually occurring.
There's ever been a soft landing.
Listen, I haven't looked back at the data.
What's the definition of a soft landing?
Yeah. Well, what are we talking about here, right?
I could see it as soft. You could see it as rock hard. Who knows?
Yeah. So inflation, the core inflation, energy has been down a lot. Mm-hmm. Food prices have been down a lot. That's the part they remove from core inflation. We still have 4% core inflation, and the Fed has said they want 2%. This is what confuses me when the Fed talks about how, I wonder how much of what the Fed is saying is actually the Fed saying it or people just interpreting what they want to hear from the Fed. I don't know. All I know is that the Fed has been very clear that they want to fight inflation, and the core inflation is still way too high. Yeah. Still 4%. And remember, if all of a sudden we see a rise in energy prices suddenly for whatever reason, now, the benefit to a recession is oil prices tend to go down because people are driving less, they're using less products, et cetera, et cetera. The whole long list, the domino effect, right? But that's still a part of inflation. The core inflation part removes that because of how volatile that can be. And compared to 2 years ago, a year and a half ago, we're seeing a lot more about corporate layoffs.
Yes.
Granted, if a company announces 1,000 people laid off, it's 1,000 people. That's not the point. The point is we didn't hear about that before. And now we're hearing for a long time. Yeah. And going back to the inversion of the yield curve, that happened in July 6th of 2022. Right. This is a long time, 17 months now of.
It's one of the longest, if not the longest, inversions.
Yeah, and
I have to go back and look at the data, but I know it's one of the longest for sure.
And remember, we usually announce recessions after the fact. Right. It's not during. We go, oh my God, this recession started yesterday. No, that's not the way it goes.
Don't really know.
It takes a little bit of time, and it's hard to see it. A possible recession because we have unemployment so low, et cetera. Are there cracks? Of course, there are cracks. There are always going to be cracks. Are there more cracks now than there were a year and a half, 2 years ago? I do think so. Does that mean you're going to lose your job and go broke? Absolutely not. But this is exactly why we teach the mantra of save as much as you can your income, live well within your means, and guess what? If there's a recession, you'll probably be fine. In fact, as we've talked about before, it's an opportunity for people to buy more great assets at great prices. That's the key there. When a recession does hit eventually, the news will be very, very bad. But you got to remember, we always come out of it better. That's my whole point. In the short run, I can be more concerned and more pessimistic. But long run, guys, it'll absolutely be better for everybody in the long run, especially those who save, especially those who live well within their means, and the people who learn a process of investing their money to get higher rates of return. If you are 10, 15, 20 years out from retirement or more, you absolutely want a recession to drive the stock market down. Mm-hmm. There's nothing you should want more. Yes, in the short run, you feel poorer, et cetera. I get that. But in the long run, you want these things to happen. You want to be able to buy better assets at much better prices. So what's going to happen in 2024? Guess what, guys? No one has a clue. No one has a clue. The market could go up 30 or 40%. The economy could get way better. I have no idea what's going to happen. But what I do know is that if you have the right process, no matter what the economy or what the market's doing, you will do well in the long run. But it's so hard because we are programmed as individuals to get instant gratification, right?
Yeah, and I mean, just come here and look at the news. This is just from our website. Oh my God, how many articles come out, and you just see them, and you're influenced by it, and you have to make a move, and you have to worry, or you have to go and buy or sell, whatever. And it's constant.
And
they get sucked into that vortex.
Yeah, and people are going to give different views on different things, right? So it's like different views on this exact same thing. One person could look at a situation and say it looks bad. Another person looks at the situation and said it looks good. The economy can probably be whittled down to a few data points, but there are millions of data points. Look at housing. Housing starts have collapsed. Well, yeah, because interest rates went up, but now interest rates have come down a little bit. So housing is getting back. It's like all these things go, but we're still at a point where we're building a lot less houses than we did at the peak, which is a good thing, by the way, for home prices. You don't want oversupply.
Right.
You want less supply. That's absolutely the key. So 2024, we have no idea what's going to happen. Nobody has a clue what's going to happen. I think the Fed has a plan for the future. And apart from some big random thing occurring, which, by the way, that's what makes catalysts that's what a catalyst is. Is the thing we don't know what's going to happen.
Right.
But apart from that, I think the plan is they're going to keep rates higher to get inflation lower, and then as time goes on, decrease rates as they see fit. So guys, 2024 could go in a ton of different directions. This is only the start of 2024. It's the end of 2023. If you want to go a little bit deeper, watch the next video.